Hello, I'm Lars. I'm apparently literally part of the furniture nowadays. Um, it's been a long day, so I'm gonna use some cheat codes over here. But I thought it would be a really fun evening after a long day to spend time with some of the amazing folks that we have over here. To talk about profitability, like how does money or how does the lack of money impact companies? There's a few facts that I've been told to read. So one is so the startup scene in Estonia, like you all know, like it's been doing pretty well, except for the past couple of years. If you look at last year's investments in Estonian startups, they actually fell by about a quarter, about 23%. And if you look at the seed round valuations of companies, they used to be about 12 million per company. Now it's about 7 million. So things are changing, right? And when valuations like this are changing, companies have to kind of rethink their approach. And this is something we're going to try to spend a bit of time on today. We have four really cool guests over here. I'll go by the faces over there. So we have Tuuliki, who leads our global people partners team at Wise. Let's give a round of applause to Tuuliki. We have Agur Jõgi. I'm assuming the T is for technology, so the chief technology officer of Pipedrive. Mr. David Gardner over here from the corporate finance team at Bolt. And Lember, who leads the finance team over at Lightyear. We're gonna spend about an hour or so to talk about five things. Profit, like do we need it? Uh, Fundraising, like so we're gonna go right to the start of a company and how it raises its lifeline. Growth, so how do you go from fundraising to profit? Growing internationally, like if a domestic market, like a small market here, isn't enough. And then finally, like how do you exit this entire situation? Which is gonna be really cool. There's a few things we talked about earlier that we'd like to try to surface. So, but let me start with Agur, perhaps with Pipedrive. Like, what do you think? Is profit important for Pipedrive? Like, do you find it important? Why is it important?
It's kind of yes, and it's not. As a KPI or OKR or whatever you call it, it's probably important. But as a goal, I think it's one of the most useless goals you can ever set to your company or to your team. It's, but I consider profit as an outcome of smart smart cooking, but not a goal. If you do the right thing in the right way, in the right place at the right time, then there will be a lot of profit. You can pay bonuses and you can pay salaries. And if you don't have the right thing or you do it in a wrong way, then there is no profit anyway, even if you set it as a goal. So I think that setting the profit as a goal will make you focus on the wrong questions.
So something being wrong in that case, like implies a behavioral outcome. Like if you set profit as a goal, maybe Tuuliki actually. Like let's say a company did set profit as the goal. So do the opposite of what Agur just said. Like what does it do to a company's culture? Like how does it change it? Is it a good thing or is it a bad thing? What do you think?
I think it's very important for all companies to think through what's the North Star metric that's important for them, that helps them to deliver what they want to deliver. The customer centricity, to enable moving towards their mission. So it might be different for different companies, and maybe on some stages it can be profits, but overall it might be different per companies per different stages.
So Agur, if you were to then go to Pipedrive and say now the North Star is profit, what's going to happen?
People will say, okay, it's boring. So we need to find an interesting job.
Okay.
But of course, I'm not undermining the profit. The profit is an important part of making a business. Investors want to see next valuation round and then next event, and then profit is an element there also, but it's not a goal. Like if you start as a startup, then you just need to have your first customers. So it's not profit; it's about like acquiring the first customers. Then you become a scale up. Then it would be nice to have some paying customers and to see that there is a growth of paying customers. But it's again not a profit. If you become even bigger, then obviously it's like Pipedrive, where we are now the VC fund owned. And then really huge VC fund. Of course, like during every board meeting, we look at the profit number, but we still talk about the growth elements, like decreasing the churn, growing the monthly revenue, growing the revenue, or growing the amount of customers in different segments, which we've been like focusing at, and then the growth profit is still kind of the outcome of doing those other things.
Do you agree, Tuuliki?
What I was just thinking that if employees would actually get some parts of this profit, if their bonus schemes or stock programs are linked to the profits, then they are more likely to figure out innovative solutions to move towards the right direction. So it depends on if it's profit for owners or if it's actually everybody or employees can be owners in some parts.
That makes sort of the fundraising aspects of a company's journey like pretty interesting. Uko, so you actually at Lightyear like recently raised the Series B. Maybe can you give us an idea of like what was the story? I'm assuming like Lightyear employees are sharing the profits or future profits. Like, but can you share the story of like how this fundraising look like at a company like Lightyear going from seed to Series A to now Series V?
Sure. So my experience with I joined just about after the seed round that Lightyear raised back in 2021, I believe, if I'm not mistaken. So I've seen, and we did multiple fundraisers in rapid succession for the reason that money was just so abundant at the time, to be honest. So it was a little bit opportunistic in the sense that we raised the seed round, there was a seed plus round, and there was a Series A, all within the span of, I think, 9 or 10 months. So, which actually meant that we were actually very lucky as a company, because we loaded our coffers up right up until the music stops, and the chairs were pulled, so to speak. And it was a very different experience back then. I would call it storytelling fundraising, because there was a lot of FOMO in the market. So even just having a team who has impressive credentials, having credibility as a team who can execute, the idea was a bit secondary, and to raise money was super easy, to be honest. And obviously, you cited some of these stats about how funding has dried up or valuations have dropped. The market is very different now. So every, the A, the B, the C, I feel like compared to 2021 and 22, what has happened that, every round has moved, or the milestones for a particular round have moved earlier. So whatever was your Series B story in 2021 and 22, now the same expectations are set for you in a Series A. And it's really not much of an anomaly. We're actually returning to some sort of normalcy that we had. I think 2021 and 22 was a crazy time. And Lightyear's story was, the fundraising was really easy back in beginning of 22. And we're a very capital efficient company. We're focusing on running a really lean business, and we already then we saw that the tides were shifting, and we really took aim at dry land, so to speak. We knew that this might go on for a while, and it did. And things are seeming to shift now a little bit. But even in this market where fundraising is picking up, but there's haves and have-nots. So like AI is getting a lot of spotlight versus a lot of seed rounds or Series A is really tough to raise still. So and now the Series B that we raised heavily focused on metrics. Like there's a very much like you have to be this high to ride this ride kind of attitude that there wasn't this formulaic approach back in 22. It wasn't like, show us 5 million ARR or we won't talk to you. Almost had no ARR when we raised our Series A. We had really good growth, traction, leading indicators were really good. Customers were joining, assets on the platform were exploding. So, but nowadays, even with growth, you need to show some of these other metrics as well. And so Series B was decidedly tougher. And especially as a finance leader, Series A was more focused on, product, traction, what's your go-to-market strategy, who's in the team, even like these are those seed stage questions actually that were asked in Series A. Like I said, things have shifted. But now it's very focused on finance. What are unit economics look like? How does your retention look like? When are you going to be profitable? Questions like this came up quite a bit. Mm-hmm. So it's a very different environment, and I think the numbers really reflect it.
Well, but it seems like there's still like these mysterious figures with millions in their pockets ready to invest. David, like Bolt has raised a number of rounds over the years. Who are the people who give you money? And like and yeah, how do you pick them, and would you do anything differently, like looking back at the people that you picked to invest in Bolt?
I think to the earlier point, like the last round of Bolt was top of the market in 2021, right? And I think we did a very similar thing where there was a round done in August and there's another one done in November, December. And I think the advice I would give is when you can raise capital, raise it, and you have to be ready to be opportunistic, because the reality is when you need capital won't be there, right? And by the time you need it, it's too late. So raise it when you can. Do exactly what Lightyear did. Take a bit more when you can, so you can bear with the bad weather. And I think the point on selecting investors is in a bull market, you can be much more selective who you take, right? And I think different investors bring different value to the table. Yes, there is value in the Fidelities and the Sequoias of the world, who are a big brand that people follow. But some of our most helpful and useful investors are actually investors you'll never have heard of. They're the people who will be sending you employee referrals. They'll be sending you other investor referrals. They'll be sending you, hey, we did this outside and work on your strategy. Have you thought about this? And so I think when it comes to picking investors, not everyone will have the luxury of picking an investor. So capital is the priority. Who it comes from is probably secondary. But I think in an ideal world, you're looking for someone who's got long-term patient capital, right? That reduces the pressure on an exit. You look for someone who's not maxing out their position size day one, because that then means there's someone you can tap for follow-ons or secondaries, etc. The broadest mandate possible, right? Because that then means that you could do primary, secondary. We have investors on our cap table who actually came to us because they were looking at doing a debt round at one point. Debt round didn't happen, but they came into the equity. So that range of both product and duration means that there are investors out there who will come into like a seed Series A, and then they'll have various funds that you can cycle through your life cycle. Like you look at BlackRock, they can do everything from a VC through to a public market investment. And at the end of the day, you have to invest in these relationships. Once you get the capital, you have to nurture it, because if you don't, you won't be able to tap it again in the future.
Right. Okay. So don't just pick for the wallet, pick also for the other values that they bring. Make sure you have a good story. So, okay. So I'm pumped up. So I found my mysterious figures. 5 of them are probably here. I'm going to tell you a good story. I'm not going to focus on profit. I'm going to focus on something more substantial. And I'm going to grow until I'm not growing. Okay, so it plateaus. Agur. Has Pipedrive gone through a plateau of growth? Did you if you did, like what did you do to unblock it? And if you didn't, like what did you do to prevent it?
It's not like exact plateau or like we definitely started to decline, but it was kind of pretty close to plateau at one moment when founders had a clear plan to exit. Then they, of course, injected some steroids, like let's do this, let's do this, let's do this, let's show up potential and opportunities. So it's like fake it.
Literally inject, or what was the steroids?
Like let's open like new business lines because those look like a logical next step. We started as a purely sales CRM, so only the sales side. But sales is tightly connected to marketing, and then you might think that okay, some DocuSign type of solution should be there, of course, because at the end of the sales process, the agreement needs to be signed, and we started to experiment with this and with this and with this, and we started to experiment with all of that at the same time. I'm not saying that we experimented with wrong things, but if you have so many new and nice and cool and potentially promising activities, and then you will call out to your team that, hey guys, who would like to do this and this and this and this, and your pride brains will go and then start building those new things. And then at one moment you just realize that but your core service is in really operational mode. And we left our core service into the operations for quite a while. And customers started to tell to us that, yeah, those are the nice add-ons and nice extra features. But I can't log in to your service, or I can't create the next sales leader because those things are not working anymore. And then it became pretty plateau until we realized that, okay, shit, we need to have the core product perfect, and then we can go to the next adventure again.
Did you stop the new fancy features in that case?
Yes. We killed 2/3 of those because we realized that besides those are just nice features, we were nowhere near even to top 10 in the world. We were doing something which was ranked maybe the 50th best globally. So what if you want to build the top world best CRM, and then you will add the world worst DocuSign to that? What's the point?
Uku, you've been in finance for longer than most of us, right? So you must have developed a pretty sharp eye when looking at growth through numbers. Do you how would you spot a growth plateau? Have you spotted one? And what do you do when you do spot one?
Well, in finance, I would say none of the things that you maybe look at in finance, say a P&L or revenues, these are really all lagging indicators of growth. So at Lightyear, we don't really focus on. Of course, we focus on revenue, gross margin, and things like that. So this is just good financial housekeeping. But in terms of growth, there's other better indicators. We look at our North Star metric really is AUM, or assets on the platform, assets under management. Our customers start trusting us with more of their money. We run CSAT surveys regularly. Are customers happy using the product? Would they recommend it to others to use as well? And so you'll start seeing dips in those metrics well before those problems start showing up on your P&L.
So when you spot them on P&L, it's too late already.
Yes. And we have been lucky to not really. So I'm not speaking of experience of plateaus, unfortunately. But plateaus or slumps in growth, these can always be relative as well. Like we've last year we tripled our size, and I think had 5-fold or 6-fold increase before that, and we're on track to triple again. But it doesn't really look that linear, like month to month, and especially if you're, a consumer finance business, there's a lot of seasonality in there. So what may actually look like a plateau is the market taking a breather. So you need to really diagnose: is it us that is taking a breather, or is it the market that's taking a breather? And that's I think an important distinction I need to make.
And when Agur, you just mentioned, like you put the brightest minds like on growth. Intuitively, you would say, it's you put the engineers and the analysts and the designers and product people. But actually, I recently read Wise's people team strategy. It's really interesting. Like right at the top, it says like our goal is to grow our customer base and improve customer NPS. I was like, that doesn't. It sounds amazing, but that doesn't sound intuitive. How does the people team impact growth, or how do non-product people, in a way, like in a company, actually push growth like that?
That's a really good question. Clearly, we have a shared mission, moving money without borders. We have very clear mission pillars, min fees, max ease, full speed. So in any of the teams, including people team, in all of our plans, we try to figure out the North Star metrics. We have North Star metrics at Wise level, but we try to figure out what are the things we should be measuring, and what are the activities we should be doing in the people team to enable the growth at speed and at lower cost as well. So there's, of course, endless metrics we can measure, and depending on a growth stage, these North Star metrics and other metrics might be a bit different. We are measuring a lot of different trends. We have quite detailed scorecards. So we try to understand the attrition, hiring speed, hiring quality, internal mobility rates, training completion. It's very important if you want to stay compliant. There's like smaller things like that. But for example, from our employee engagement survey, we try to understand, for example, confidence to use AI, and taking the feedback from the teams. How could we enable teams using AI more? We measure AI adoption in the teams, which would enable us automating more. So there's a lot of trends we can measure, and a lot of strategic initiatives you can take. It can be smarter, more strategic workforce management. What's the employee structure, outsourced teams versus in-house teams, in which locations to hire, which are the future skills, are they available in Estonia, should we hire them in India or Brazil, or does it matter where they sit? So there's many things to measure, and it's just important to understand if it's profit or something else that is important for you to reach your company's mission and overall goal, and just to monitor it as well, because often you get what you measure.
That's super interesting, right? So you look at, how do we improve customer NPS? Well, you make something more efficient. How do you do it? You use AI for it. Why are we not using AI for it? Turns out you're finding out, people don't know how to use AI or are afraid to use it. Super fascinating. But growth only happens, if you contain growth to a small country like Estonia, for example, it's quite hard to grow beyond a certain point. David, you're in a company that just grows phenomenally around the world. I don't even know in how many countries you are, but it's very clear that you are in a lot of them. Tell us about your international growth. Like, what's, where are you today, and what's hard about expanding Bolt to all the countries that you've grown to?
Yeah, so Bolt operates in over 50 countries worldwide, over 600 cities. 80% of the business is in Europe, half Central and Eastern Europe, half Western Europe, and 20% so from other markets in the rest of the world. We operate everywhere from Nigeria to Norway to DC to Thailand. So huge diversity of markets. I think the biggest challenge with geographic expansion as a growth lever relative to other levers you can pull is frankly uncertainty, right? You can say, well, this city should be analogous to this city, or you can look at sort of previous trends and market launches and say, well, I'm going to go and I believe that a new launch will follow this trajectory. Doesn't matter, it's going to be wrong, right? Sometimes positive, sometimes negative, but it will always be wrong. Doesn't matter what cohort data you look at, it will always be different. And so with geographic expansion, the biggest issue is that uncertainty. And that uncertainty can come from a number of factors, right? It can be regulatory, it can be FX volatility, it can just be customer behavior, right? We were talking about how you localize a product for the market, right? The product might be not as suitable for that local market as you first think. So I think there's a few ways to think about that expansion and de-risk it as much as possible. First of all, when you think about allocating capital to geographic expansion, you have to use a different hurdle rate. So the way we do it is when we do a capital allocation process, there are modifiers for the target return that you need for an investment project. If we're launching a new country with a new product, that will be one of the highest return hurdles because it's the most uncertainty. And this all comes down to your cost of capital. Where you have more certainty, you can target a lower return. And then the question is, what are the levers and things you can do around geographic expansion to minimize that risk? Do you stick to the Eurozone to strip out FX risk? Do you stick to certain pockets where regulation is analogous or where your customers operate in multiple markets? There is a much bigger TAM out there than your home market. There always will be. But it's a high risk and a highly uncertain form of growth. And I think you just have to be sort of realistic about the range of outcomes. And then when it comes to capital allocation, you factor that in about your target return.
Okay, so try to simplify and play it back to you. So you're looking at a market, you have a big spreadsheet, if you will, with all the variables, like how many potential drivers there are, etc. And you try to estimate, okay, I'm going to make that much profit, therefore I should invest no more than X. Is that?
Yeah, that's fair. I think the way to look at it is you look at a market and say, okay, what is the addressable market? What market share of that can I take? And what could my profit in that market be? Mm-hmm. What is the range of outcomes on that? If I'm right to the upside and downside, what's that going to look like? And therefore, it's a little bit like placing a bet. What's my risk reward in that investment? And therefore, do I put more or less money to work?
And what's the limiting factor? Like, what's stopping you from, like, you mentioned you're in 600 cities today. Why not go to 6,000 cities tomorrow? What's the thing that's holding you back?
Capacity, people, and capital, right? So I think you have to be careful not to do too much too quickly, right? And I think sometimes companies make the mistake of expanding to too many markets too quickly. What that does is it adds complexity to your business, especially in things like central costs, because all of a sudden you're having to deal with multiple currencies, multiple regulations, multiple filings, multiple entities, intercompany pricing. Like, it gets very complicated very quickly. And I think it's much better to do fewer things well than do too many things badly. And so the way I would think about it is, if you're looking to expand to your first market, the question is, okay, where can I add TAM? Where is it analogous to where I already operate? And where can I minimize the risk? And then when you go to raise capital, the message is, I have this proof point. I have this market that is already this size doing this profitability. This was the trajectory of it. And this is why I think if I can replicate this in country ABC, this is what the business could look like. And so investors are willing to put capital behind geographic expansion, but what they want to see is copy paste. I've done it before and I'll do it again. And here are the KPIs and metrics to prove that.
Right. I think Lightyear has done something really smart when expanding internationally. You mentioned that you tripled your growth, like in last year. Like, Lightyear uses Wise to move their liquidity around Europe to save money in international fees. Uko, what are some other tips and tricks, like, as you're scaling the business internationally to make international scalability viable? To David's point, like, because it's very easy to kind of shoot over and just run the business to the ground. Like, what are your tips and tricks?
Well, definitely use Wise for your business. I hope I'm earning some brownie points. But in all seriousness, I really liked David's answer because I think our playbook is actually like somewhat different. So we're creating controversy here. Our playbook is such that we have a broadly useful product and an investment platform that sure, there's things that you can do in terms of localizing. Maybe there's language, maybe there's tax support, a bunch of things that you could do and make it specific to a market. But what we've done is actually launch like a broadly useful product, and we launched 19 countries all at once in the Eurozone, like with a very light touch, no localization, no nothing, only English language app. We open it up to everyone, because the underlying infrastructure is built for scale, and customers find it useful. Of course, you can go deeper, and to really win a market, you need to localize. But we use this as a way to see or let the customers tell us which is going to be the right market to really double down on. Because this allowed us to see where the traction was, where did we really feel the pull of product market fit, whether it was just a market that's heavily underserved maybe, or some other reason, ease of use. So that's been our international expansion playbook. Open up to a large swath of markets all at once. With very little push in terms of actual marketing spend. So we didn't really deploy capital at scale at those markets, but we did use it to get signal. Like, where are customers really finding already the kind of the base layer of our products super useful, where it's valuable for them, and we uncovered some nuggets this way. Like, to our surprise, for example, Hungary, a place we would have, wouldn't have been our maybe first pick or second pick, and started growing like gangbusters with zero localization. And then when we doubled down on localization, added some, tax efficient accounts, local currency support, etc., things really, got going. So, I think it really depends on how much capital do you really need to deploy at a specific market, or can you open far and wide without really deploying a lot of capital. So I think we've done something different to a lot of the incumbent, especially in financial services. This is a very fractured market. Companies tend to take their time and then go sequentially market to market to market. We had a competitor, for example, in the UK that took 2 years to go to Sweden, and then they packed their bags afterwards because it didn't work, and they deployed tons of money in building it out. So this way, it's actually de-risking the whole process. You're not deploying a lot of capital, hoping that your thesis is going to materialize, but rather, you open the doors, see where the signal is, and then double down in places where you can see a blip.
It's super interesting, right? So you have two very different approaches, and both are obviously working successfully. In one case, you do a calculated decision which of the next, which is the 601st market, and on the other end you have, let's just open them all and see what works and double down on the ones that start to fly, because you never know which ones are going to fly.
Yeah, I would comment that of course, like for Bolt, like running a double-sided marketplace, like there's no way around deploying capital, right? So for us, like we can literally just open the doors and people will come. So these are probably maybe not even like opposing strategies in a way. I'm sure if Bolt could like open the doors everywhere at once without deploying a bunch of capital, I'm sure they would. But yeah, financial services is definitely.
It comes down to finding the right growth algorithm for your business, right? So to your point, like we have to go and sign up drivers, we have to go and sign up restaurants if we're doing food delivery. There are some markets there's a number of markets where regulation permits that we actually do a very similar approach, where we basically just open the app and see if word of mouth takes off. Sometimes you get virality in that, and then you can press the bed and really allocate capital to it. But they're the exceptions for us. But it's really about finding the playbook that works for your business model, because that's the playbook that investors are going to back, right? And there's no point in us having the same playbook, because our investors wouldn't support that model, your investors wouldn't support our model. So find the model that works for your business, and then that's what people will back.
That's super interesting, right? So, but the common theme that I'm hearing from both of you is like, don't wait for the product to be perfectly. Just launch it when you're ready, just to get the traction, just to get people to really use it. But let's say now, okay, so I have raised my funds from my fabulous investors. I've grown internationally. I've used Wise to save money when moving money from one currency to another. Good tip. Now I'm thinking of, okay, maybe I've done this for 10, 15 years. It's time for an exit. There's various ways of exiting. Tuuliki. Wise kind of did an exit, right? So Wise listed in the London Stock Exchange in 2021. It was the largest direct listing in the UK, which meant that instead of having book building happening by investment bankers, the Wise stocks were all put on an auction essentially for people to bid on. And then you joined. So you joined when we were already a publicly listed company. And the biggest fear that lots of folks have is like, how does the culture then change? So how does the culture change, and how has it changed whilst you've been here at Wise?
So I've been with Wise for 3.5 years now. I've been in different companies as an HR for 20 years now, and I can confirm that Wise still has a startup mindset, startup ways of working. We have lots of talented people finding creative ways to solve impossible challenges and staying compliant as well, and figuring out how to scale at speed. So clearly, once you grow from startup to scale up, at least for Wise, the mission itself has remained exactly the same. The DNA is the same. But of course, what changes and has to change is the ways of working and the decision-making process, for example. So when you're a startup, then there's less processes, less structure, a bit more chaos. But once you scale, you just need to build more governance. You can't be, as a lead, involved in every single hiring decision, in every single product launch. What does it mean for Japan? What does it mean for Sao Paulo? The teams will be so much bigger, so you need to build governance and structure to ensure that you are involved in the most important decision-making processes. But to trust your teams to do the rest of the decisions. So clearly, the overall governance. A lot of startups initially start in a local markets and then move global. Wise already started as a global business, solving a global challenge. So it didn't change for us that much, but clearly we constantly need to rethink the operating model. Wise is already 7,000 Wisers strong. We have 28 locations. We are serving more than 15 million active customers all around the world. The complexity constantly grows. So we need to constantly rethink the decision making, the governance model, the teams. It doesn't matter in which locations they are. Maybe it does matter now. So it's important to think through the operating model constantly. And of course, what makes the culture strong? It's strong leads as well. So the leadership itself, the ways of leading teams will evolve over time from hands-on management to empowering teams, coaching team members, hiring the right people who would lead your teams. So it's very important to have very clear mission, to have very clear goals, these North Star metrics, so that each of the teams knows what are the things, what's the direction we are moving towards, what's the shared goal. So clearly it has changed, but the DNA of Wise is still the same.
And it almost sounds like it has very little to do with being a public company. It's just the nature of being a big company, right? Agur, you actually work at a very different company. When we were chatting before, you mentioned something fascinating. Like all of the other companies here, Lightyear, Wise, Bolt, are still founder-led, whereas Pipedrive is something very different. Can you tell us about what's going on in Pipedrive?
Yeah, how the culture has been evolving. I need to call out Kadri and Arho sitting there in the middle, as they were really early days pipe drivers, and they left after founders have left already the company. So after Oh yeah, and Agne is there. I think that it's exactly the right point that it's not only the size of the company, but it's also like in which phase you are with your company. Like you can be like huge but really startupish. Then you are focusing on certain topic and that's like move fast, break things, reinvent all the company and all the product like every Monday or even every day. That like attracts certain type of people who have like high risk tolerance and they like this a bit of chaos, and then you will start having customers. And then you will see that some of your early customers will leave because they actually say that we don't need a new product every Monday. We came because of this product that you had like 2 weeks ago. But now as that product is disappeared because you were like so bloody creative, then we are leaving also, as we don't need this version of this product anymore. And then you simply need to start thinking of like a bit of operations and a bit of planning, and those then the early startups, it's boring for them. It's not good or bad. It just is. And then if you will end certain rounds of investments, then obviously those KPIs will start changing. And like even if I'm not or as I'm saying that the profit as such is not a goal, then kind of the rule of 40 or nowadays like rule of 60 is still something what your exec team and your financial team keeps talking and asking and challenging. So there is a bit of like annoyance. Like I came here to solve the global problem. I really like the company mission, but then there is like annoying questions come in, and then I will go like back to the private equity because the VC is like that's too corporate. But in Pipedrive, I think we clearly have higher by the same values that founders created. So we are not founders driven anymore, but we are still like founders created values driven. And then most of our hiring is focusing on like trying to find a match with values. And maybe the last round of interviews, maybe even not that, is focusing on technical skills. Like, can you actually do the stuff why we are hiring you? Because that's something that you can learn. Like, go to Preet. He can solve like every company, every problem with AI with just one prompt. Because it's the technologies are changing and the ways of working are changing. But if you're not curious, if you're not willing to learn, if you don't want to be the best in your skill, then this great technology and great ways of working will not support and will not help you. So the founders' mentality should remain in the company, even if the founders leave. What it is for us are those like Pipedrive 6 values, which we orthodoxically still follow and challenge our people to meet them. And like we have, if you come to our office, like you will see a lot of screens everywhere. And they're constantly running those internal like shout outs that I saw you doing something like this, which is exactly promoting this value. And then like all that the internal recognition still happens around those things. So yeah. There is no one way to have your culture alive forever. The culture keeps changing accordingly. Founders in, founders out. Startup, scale up company, one market, many markets. In Pipedrive, we have 58 nationalities, 10 countries, customers from over 108, pretty much all countries which are not in the sanctioned countries lists. We have everywhere like paying users. So, but still, those 6 values which founders introduced.
That's incredible. Like we started talking about profit, how it's important, and now you folks are telling no, it's sort of is, but actually no, there's the other stuff. We talked about exits, like being a publicly listed company or being a private company, founder led, not founder led, and none of this is like actually deterministic to a company's success, which is really interesting. So, David, I'm hearing rumors. We were talking about exits over here. There's a bit of a VC flavor over here. There's a bit of a public flavor over here. But both you and Uku earlier mentioned about getting the timing right, right? I appreciate you probably cannot actually say much, but if you were to kind of talk us through perhaps like, what is the right time to start thinking about an exit? And if you were, someone in an earlier stage business than Bolt is, like what would you say to a founder, especially in a fundraising stage, to think about now that would make it the thought process of a future exit simpler and easier?
I think everyone gets excited about IPO, right? But the reality is very, very few companies go public. The vast majority of startups and companies exit through other means, whether that's a trade sale, whether that's a sale to private equity, whether that's a combination with another business. Like, there are 3-4 different ways you can exit a business. I think it's a hard pitch to go in a Series A, Series B and tell a VC that you're going to IPO, because they're going to look at that and say, 2 out of our 100 companies in our portfolio have done that or do that, right? I think about your business. What could it look like in 4 or 5 years' time? Are there obvious people? Are there obvious buyers for your business, right? Look at Skype, look at others, right? There are obvious owners for a business. To go public, you need to be of a certain scale, right? In Europe, that's about a 5 billion valuation. In the US, it's closer to 20. Very few companies are able to achieve that. And it's also a pain, right? Going public, as you will know, is a lot of work. Governance, compliance, functions, regulatory. It's a distraction, and it's a ton of work. So many people think about an IPO as like the North Star. I think for a lot of investors and founders, trade sales are a much, much easier exit than an IPO. But it also comes down to, what do you want to achieve, right? Are you here to create a company, sell it, monetize it, move on and do the next? Or do you want to try and create like a lasting legacy in the public markets? I think it really comes down to founders and what they want to achieve. Then you have to look at your business and say, okay, could this business theoretically get to that 5, 10, 15, 20 billion valuation that can stand up in the public markets? Or is this actually going to be a tuck-in acquisition for one of the mega caps? I think the way to sort of position yourself and think about that for the future is, if you know what your options are, you can then work back from that, right? If you are going to go public, there are things you can do today around where you put your top co, what your governance structure looks like, what your shareholders agreement looks like. But that's more of like a Series C, Series D type question than a sort of A-B type question. But if you are really going for an IPO, then there are things you can do around sort of structure and setup today that make your life easier. And to your earlier question on investors, picking the investors who will support you through into the public markets also can help with that. I think when it comes to a trade sale, figure out who your buyers are. Start conversations early, right? We as a company, we acquired a business in Denmark earlier this year that we announced. We look at 50 to 70 acquisitions a year, and we made one, right? So we are constantly talking to competitors that are popping up in a certain market, like, oh, should we buy them so they don't get too big? To your question on geographic expansion, should we enter through M&A rather than through organic? So if you are looking for a trade sale, figure out who your buyers are. It can be a list. Spam the corp dev, biz dev, M&A leads on LinkedIn. Start a conversation. They're going to want to start tracking you early. And what all of your potential acquirers will want to do is they will want to avoid an active sale process where you go and hire a bank and run a process. So it's in their interest to maintain that dialogue with you. And I think so, as you think about exit, what are the options to you and your company? What do you as an individual want to achieve as a founder? And work back from that.
Very cool. Thank you, David. Folks, we're going to take maybe about 7 minutes to for you to ask any questions from our esteemed panelists. And then we're going to close it off with closing thoughts. So there's going to be a microphone going around the room. If you have a question that you'd like to ask the panel, this is your moment. This is your time to shine. Yes, there's a question over there in the back.
Okay.
Please state your name, where you're from, and then ask your question.
Thank you. Linda from Karma Ventures. So on the opposite side of the table majority of the time. And I'll direct my question to Agur, but I'm sure that the finance kind of side can answer this question as well. Oftentimes, what we're trying to see if there's been like really good product market fit, especially like during Series A, you kind of go off for this kind of, looking like a hockey stick. And then at a certain point, for some reason, a plateau comes. Sometimes it's the product market fit goes away, or it was a very defined group of people that were very, very interested in your product. So you as a technology lead, how do you kind of think about it yourself? Like, when is it time for you to step up and figure out whether it's like, hey, this is on our team to kind of figure out how do we kind of make the product into kind of something that's more akin to it? Or what's the process that you'd recommend to anybody who's in that state right now? And as either a CEO or a CTO is trying to figure that out, and on the finance side, like, how do you see that and how do you figure that bit out?
Great question.
Yeah, that's a really great question, and I have very easy answer to that also. Like, hire Sergei Yanikina. He's the best fit there early days CTO role. But truly, like, I think that if companies losing product market fit, then CTO can save that. But what CTO can do is that if the company is still building up and trying to find the product market fit, then the CTO must be joining all those smoke something, go to sauna, strategic meetings, whatever you call those, because engineers eventually at one moment will be the only source of truth, knowing that what this product actually does. Because business people and business use cases, those come and go, and you rarely see any logical connection between your use case number 1 to 10 and the use case number 1000 to 1200. Those are probably talking about quite different story. And then your engineering capacity is something that actually knows that where we started from where we are and what can be done in the future. So have engineers close, but it happens. Life happens, like COVID happened, things happen, and some like hotel business got like kicked out from the market for a while, and they had to become really, really creative to stay alive. So those things happen. But if you have all your like key roles constantly discussing, debating, and challenging the product and the product market fit and the actual customer needs, then it's pretty difficult actually to lose the entire product market fit. You may lose a segment, but not entirely.
Okay, David, you're the finance guys in the room.
Yeah, I would just like in my experience, there's no growth hacks. The only really sustainable growth strategy is building a really good product that people want to use. We have all of our growth inflection points that we've seen in the history of Lightyear over the last 4 years trace back to something that we did with the product. We built something that really pleased, delighted customers. And that's the only way to do it. Yes, you can find like unlock pockets of growth and like some marketing channels that you haven't tapped into, and maybe you can accelerate momentum that you have with marketing, but you cannot create it. I think that's like the finance lens at this. That there's not much we can do on the finance side to fix that problem.
Mm-hmm. I think this is where, from like the finance perspective, you need to be very close to the product and business teams. I think all too often, finance teams will get sort of the month-end report or the quarter-end report and look at sort of net income and cash flow, but actually understanding the build-up to revenue, understanding what are the levers to build up to, whether it's GMV, whether it's AUM, like is it customers, is it percentage of wallet, like what's, and having the data and the infrastructure that you can actually go in and drill down to certain metrics. Is there a change in cohort behavior? What does that tie to? Is it a weather pattern in micromobility? Is it a product launch at Lightyear? Having the data and understanding how the business drives the numbers. I think all too often finance functions are slightly removed from that. And so you really have to be a partner to the business and understand how the business operates and how the numbers are an output and not an input to the business.
Maybe if I can add from a product point of view, one thing we do at Wise is we listen to the customer feedback. One of those sources would be the Net Promoter Score comments, and you can kind of split them into detractors, neutrals, and promoters. The way you build the product is by looking at the detractors, because these are the people who are going to tell you exactly what's wrong with the product. And then the way you then fix the product is by building exactly what the customers have asked you to solve for. Not something different or solving a different problem because someone else in the market is something. No, you solve exactly what they're asking for. And then you use the words of the promoters exactly how they're described. Not using similar words, but using exactly those words to do product marketing and marketing. So if someone, for example, uses the word, "Oh, your product is very, very fast," you don't use the word rapid to describe your product, or you don't use speed even. You use the product is fast because that's how one customer intuitively describes the product to another customer. So you look at what's broken in the product and you solve exactly for that. And you use the words how the product is described to describe it even further.
There is like other way to approach the same topic is that you actually will throw away all those detractors and you will ask customers that whose life becomes miserable if we close down our service. And then you focus on those because you want to share exactly the same words and then the same message, and then you want them to be part of your development process because eventually there will be more and more of them. And if you will start focusing on detractors, then to open them up until they start telling the real story, you're just wasting your 2 weeks. And then with those 2 weeks, you can build up the promoters cohorts. But my point here is it's not to fight with a wise strategy, but pick one and then follow this. If you are into the NPS, then do it and then focus on that and do it greatly. If you follow my story, then do that and don't try to mix those two because then you will have a really hard time and you will lose everyone.
And what's interesting is it's not a finance question by the end of the day. It still comes down to the problem you're solving for the customers and the product you're building to solve it. We have time for one more question.
We have time for a couple more questions. Yeah. Uki, you were just about to say something there.
I was going to react actually. There is one situation I think where finance actually does chime in, and those questions we've labored over at Lightyear quite a bit, which is pricing. Is that you at some point you're going to want to monetize your product, and what you really don't want to do is have your value capture outpace your value creation. I think that's a place where finance can maybe prematurely step in and start talking about revenue targets where you're still kind of fumbling around with early product market fit, and you really don't know what you have on your hands just yet. So careful there not to break something or try to fix something that's already working. I think that's maybe a thought on that.
Hey, my name is Omar, and I'm running a hiring agency for the past 2 years. And the pattern that I've been noticing personally from my personal experience is we used to give junior developers, medium developers, senior developers for US startups. But in the past 6 months, it has been mostly senior developers that have been, or most requested developers. And I have because some of the junior developers, they are my friends, and because the company operates in Macedonia and Estonia. And my question is to you, when it comes to hiring and scaling up the new companies, is it an issue that you maybe target to hire mostly senior people and then ignore the whole facet of juniors? Because that's something important that I've noticed for my business, and I don't want it to go like that because then the pipeline gets shaken, no more juniors are coming and I can't hire them. So that's my question.
I can comment from Y side. We are still growing at full speed, so we are hiring at all levels. It's a short answer. We do have apprentice programs for early grads. We hire seniors. Of course, AI is doing some of the more junior work in some parts of the org. So by utilizing AI more, we can actually hire for more complex roles. The roles themselves are getting more and more complex, so we do need to specialize, and if we can choose, we do prefer highly specialized skills. If we cannot choose, we hire more generalists, more juniors. So it's depending on a market, depending on a function. But at Wise in Tallinn, we have 2,500 Wisers and growing. It's a full stack office. We have all functions represented here. We have more than 300 different type of roles. So the short answer is we are actually hiring for all profiles.
In Pipedrive engineering, I think for the last 2-3 years, we've been hiring mostly juniors, 95%. As the logic is that the value match is important, and then ability and curiosity to learn. And old people like me, I'm really curious to learn, but I'm really slow also because I'm too old to learn fast. As I have many other questions also, but why this and why that, and my experience tells something. And the young people, they don't have this backpack of experiences, so they can really move fast. Then we also want to see some logical, like blood circulation, like you need to get fresh blood into the system also, and entering the fresh blood, you like to have it like as full of oxygen and ideas and fun and everything, and that's again like usually we'll get from the juniors. And today is anyway like we all on the same level, like what to do with AI, nobody knows. Some generates PDFs, some does actually something valuable, but it doesn't matter like young or old, senior or junior, or like finance or marketing. Like be curious, start experimenting, and then you can conquer the world. So the juniors do much better for us.
One final question, and then
We've got 2 more questions I can see. Were there any over this side? Okay, so I'll start here and then we'll pass up to you.
All right.
Hi, my name is Sadie. I'm a coach, so I'm supporting some of the founders and some of their teams. I have a question around giving up and knowing when a market is not working and when is the right time to actually say, guys, this is it. We tried our best, because there's a lot of positivity, a lot of optimism, which is, I think, great. But I'd really like to know, what are the levers, what are the criteria that you guys look at when you have to decide if something's a pull the plug kind of operation?
So at Bolt, I say we operate in 600 cities. We've launched over 1,200. So we have a view which is you can launch a city, you can see if it works. If it doesn't work, we pull out and we can relaunch it. Helsinki is now a very strong performing city for us, and actually it's the third time it was third time lucky, right? So the first couple of attempts didn't work, various reasons, whether it was regulation, whether it was taxi lobby, etc. I think to the point on sort of expansion, right? If you're expanding, what do you expect to see, right? And it can be various metrics that you're tracking, whether it's AUM, customers. For us, it's supply side. We look at driver signups, for example. When we launched Canada this year, we exceeded our year-end target by month 3. So like, okay, we're tracking really, really far ahead of that. I think it's, okay, what are the metrics that matter? If I'm underperforming those metrics, why am I underperforming those metrics? To the earlier point, am I able to fix that either with some product development or a tweak in strategy? And I think you have to at least, if there are factors under your control that you can change, you can try and change them. And then it comes back to an earlier point on capacity, capital, and people, right? How much resource am I willing to dedicate to this? Because what is the goal if it works, or what is the reward if it works out? And so I think as you think about a launch roadmap, sometimes we have a launch roadmap where we have certain hurdles that a project will get a certain amount of capital, and if it hits certain targets, we will then put more capital to work. And so I think in some ways, the question is, when do I give up? But I think you can almost set your parameters when you start, which is, this is how much time and resource and capital I'm willing to dedicate to something, and this is what I need to see. And in most projects we have gates. So when you get a management approval, you have an approval to spend X to get the project to this stage, and then you come back with your results. If you meet those, then you go for a reapproval for gate 2, gate 3, gate 4. And I think that's how you do it. It's less, if you don't have a plan, you don't know when to give up. But if you have a plan, you know what to track and how you're performing.
And if you're really early days startup, then like you told about few numbers in Estonian startup ecosystem, the one other number says that more than ever startups go into bankruptcy. And I think that's really cool because you can only learn from the failures. You don't learn from the success. And then that's like flipping the coin to answer your question is that if you're a founder, you have certain expectations, and that in the early days it's a growth expectation. And if you can't meet your growth expectation and you're running out of the ideas, then close it. Don't hope that that I'm out of the ideas, there is no results, and at one moment like the results just starting to appear. Then they won't. And that's something that Estonian startups, including myself, during my earlier years, have been like really good, like just actively, like really going to the office and doing things and burning out and then hoping that I have no ideas, my team has no ideas, my mentor has no ideas. But if I will still survive for 12 more months, then the world gets bright again. It doesn't.
Thank you.
Thank you for the optimism. Just do one final question.
All right, we'll do a final question and we'll do a quick one and then we'll start to wrap it up. Thank you. For anyone tracking data, most questions came from the back. I don't know what the correlation is, but my name is Michael. I'm the founder of a streetwear brand called Maison Beast out here in Estonia. We've done quite well here, I'll be honest, and now we're starting to scale abroad. And the question I asked myself is, back when you guys started, it was very sexy to be a startup out of Estonia. And I'm wondering whether it still is, because when we're trying to scale today, we need tools like Klarna and Afterpay and all these things that are not available in our country. When we go to talk to investors, they're like, okay, if you're going to do an exit in the future, maybe you should consider to move the headquarters somewhere else. And now you guys obviously are big and you're able to enter these markets quite easily. But when you were smaller and you were expanding into these new markets, I'm just curious whether you still kept it under the Estonian structure, whether when you were expanding, you were opening local businesses. I'm just trying to figure out how and which is the best way to go. And is it really still sexy to be an Estonian startup?
I wouldn't call us a startup anymore, but our top co is still in Estonia. I mean, our share, like, it has its drawbacks. I never thought I would have to get into the nuances of Estonian corporate law when I had to think about shareholder approvals, but it is very different to certain markets. That's a problem for the future. I think it sounds like. I would say it is still sexy, right? You mentioned Klarna. One of their largest shareholders is one of our largest shareholders, right? I'm based in London. I spend a week, 2 weeks a month here. Anecdotally, the amount of people that I know in London who are now sort of looking at Estonian startups or coming here for work, like coincidentally, my brother's just taken a job at an Estonian startup, right? So it's pulling people from international markets, and it has got this reputation for being an early stage hub. I think the question on sort of Topco and headquarters, I think it's almost like a question for the future, right? Where pre-IPO, I think Wise has always been a UK business. Generally, when you get to the public markets, you need to think about moving to Topco. It's more of a legal technical point. I think for attracting talent and attracting capital, there's no issues with being an Estonian startup. And I think you've got multiple very successful companies who have raised money. And so if you're looking at raising money or attracting talent, I'd be looking at the investors who have backed companies in the region previously. Like, we still do it as even at our size, as we'll look at companies who have, or investors who have been active in the broader region. So anecdotally, sitting in London and seeing the amount of people who are obviously commuting these days to Estonia and working for early stage companies, I think there's no need to move.
That might be a London problem, though. I think this panel over here is evidence that you can make it as an Estonian startup as well. So it probably, if we were to summarize, it comes down to the ingredients that the panelists talked about earlier. Sure, there are nuances. Sure, there are some drawbacks, but there are a lot of advantages as well. I think Lightyear, I like to call Lightyear the third generation of Skype money, with Skype being the first generation success story. May it rest well in peace. Wise being the second generation, if you will, and Lightyear now being this third generation of that lineage. And with every generation, you get a panoply of new startups, new ideas. But those lessons remain, those people remain, those contacts remain. And you'll have that access in such a small market that you would struggle to probably get access to in many others.
I think out of that, the one of our startup ecosystem challenges is actually coming out that the one person can do maybe 3 rounds, maybe 4 rounds. At one moment, those people will get old, and then will their kids be same successful, and will they drive for the same? That's still to be seen. So like our startup community are those like people who really invented it and made it to become a community. Those people are aging and maybe not going to sauna every night anymore to find the next round.
But speaking of wisdom, let's try to close up this panel. This has been an absolute thrill and an absolute honor. Why don't we go one at a time? What will be your like one key piece of advice you have for the audience? Let's start with you, Tuuliki.
Have a great product. I would still add more. If you have a great product, it's easier to build a strong company culture around it, who are mission-driven, customer-centric. And the tip is to make all employees owners. Is it through stock or is it through bonus, so that they could get a share of your profits?
David?
I think when it comes to fundraising, always do a bit of secondary when you do primary, because to the point on people, it's a massive retention tool. It's a massive way of attracting talent. And I think if you don't do it, you're creating a problem in the future.
Okay.
I'll be greedy and I'll leave you with two closing thoughts. I think one, actually, I'll echo what Tuuliki said, is that best marketing strategy is building a really good product. So that was a growth tip. And then for fundraising, best fundraising strategy is building a business that doesn't need money. So that's both of these lessons, while quite cliche, like I've lived through at Lightyear. We've been in a stronger position raising money because we've raised when we didn't need to, and all growth inflection points are product-led. No marketing hacks have done it. So those would be my two words of wisdom.
As you all like Estonian startup founders, or you founded your startup in Estonia, then you are utilizing already like at least 3 really important pillars that we have. Too few people, so you don't build anything for just for Estonia. Do difficult language, so you don't do the single language. And as there are the very few people talking a strange language, then you're not optimizing also for their wallet. So you will do the multi-currency from the scratch. And then if you will add to the mix the same story, that have a customer advisory board always joining all your planning and strategy meetings, so that the voice of the customer is constantly there. It's not like we are reading feedback that they are giving to us. It's literally having a physical customer in your room. And then I think that's a perfect ingredient to build whatever level startup you want.
What an amazing panel. Thank you very much.